Central banks, CPI. We finally made it to this week. This week is going to be highlighted by a number of central bank interest rate decisions, as well as the all-important US CPI data for the month of November. Let's take a quick look at what we're expecting and what the market is thinking as far as that goes. First of all, we have the Federal Reserve meeting on both Tuesday and Wednesday. They start the meeting on Tuesday, completed on Wednesday. At 2 p.m. they announce an interest rate decision. Within that interest rate decision will also be the projections for the quote-unquote dot plot and also central tendencies for things like GDP, employment, interest rates going forward. So that's going to be a key benchmark, if you will, for Federal Reserve officials. Where are they thinking for 2023 and beyond? How do they see the terminal rate of the Fed funds rate progressing? We know that the expectations are somewhere in the market, somewhere around the 5% level, where the market is projecting a terminal rate to be. Is it higher from the Fed? Remember, they announced a higher rate than was expected by the market at their last dot plot. So would not be surprising for them to do the same thing this time, because inflation still remains up there. Speaking of inflation, the CPI data does come out on Tuesday ahead of the Fed meeting, and that the expectations of 0.3% versus 0.4% last month, and also the core measure is supposed to come in at 0.3%, which was the same as last month. The year-on-year CPI is expected to come down from 7.7% to 7.3%. Why is that? Because the reason is because this month's 0.3% replaces a 0.8% rise that we saw 1 year ago. So that number is going to back out of the year-on-year data, and it's going to be replaced by a 0.3% number. And that's how the inflation starts to move down. And moving down by 0.4% from 7.7% to 7.3% is a step in the right direction. The bad news is it's still 7.3%. It's going to take a while for that number to get down toward the 2% target. And if you want to take a more bearish look at it, imagine that 0.3% becomes the norm, and we get 0.3% because the 0.3% for every month this year, 0.3 times 12 is what? 3.6%. So that is not near 2% as well. So we could have some problems here as far as inflation, and that's going to be addressed when the FOMC meets and announces their statement, their interest rate decision, their terminal rate, so on and so forth. Do they care that, do they look at it as a 3.6% or thereabouts as something good for 2023 that allows them to slow down the pace of tightenings, or will they think of it as not good enough yet and that they got to continue their pace of tightenings going forward? So all that's going to be decided on Tuesday and Wednesday through the CPI data and the FOMC. And then we're going to have the market reaction to that. And that's where we get into things like the technicals, which I'll go through in the second part of this video today. Now, in addition to the Federal Reserve, we also have a number of other central banks meeting on Thursday, actually. The SNB, Swiss National Bank, meets, and they're expected to raise rates by 50 basis points from 0.5% to 1.0%. The Bank of England is expected to raise their rates by 50 basis points from 3% to 3.5%. And the ECB is expected to raise their rates by 50 basis points. I'm thinking 75, but 50 basis points is probably the expectations from 2% to 2.5%. So all those central banks coming in as well, announcing their interest rate decisions, causing havoc in the market in the month of December. But the good news is that we do have things like technicals that will help us tell the story about how this price action is manifesting itself into the markets. What are the biases and what are the risks? And that's what we're going to get into next. So big week ahead, CPI, interest rate decisions from a number of central banks. We'll see how it all pans out. But in order to be ready, you need to understand where the risks are, where the levels are, where the key bias defining and risk defining levels are in the market. And that's what we're going to go through next. All right, now let's take a look at some of the technicals that are driving the markets and what the biases are saying. We'll start by taking a look at the euro versus US dollar. And if we look at the daily chart in last week's trade, we saw a move down initially and then moves to the upside toward the end of the week. dollar selling. And in the process, we moved above the 50% retracement, the 50% retracement of the 2022 trading range. High right here, low right here. The 50% comes in at 1.05155, and the market is closing above that level at 1.05331 or thereabouts in the Friday's trading. So that's above that level, but as you can see, we've been trading above and below it over the last for the month of December, for the most part. Every day this month has seen the price move above and below that 50% retracement level. At some point, we're going to get a breakout. Maybe the market is waiting for these events that are going to happen this week, including the CPI and the FOMC rate decision, to make their decision as far as where we go, and the ECB might add that as well. So it's going to be a key week, and my guess is that at some point we're either going to break to the upside or break to the downside and outside of this range that we've seen in the month of December so far. So that's what we have to look forward to. We'll see how it all pans out. The 50% retracement is going to be the barometer in between the upside and the downside. Even though we've traded above and below it, I still consider it a barometer for more bullish and more bearish in the market. So be aware of that 105.15 level. On the daily chart here, what can we expect on the top side? And if we look at the swing levels going back to these areas through here, where we had swing high or swing low, swing high, swing high, we broke to the upside right here and then reestablished this area as support. And then we broke to the downside and reestablished this level as a resistance before rotating all the way to the downside through here. Now, we haven't reached up to this level yet, but we got close to it in the early month of December. 106.15 to 106.40 would be the level that we need to get to. And through on the top side, if we get above that level, then we're going to open up the door for the 61.8% retracement of the 2022 trading range. And above that, we have this swing area where we have different swing lows and swing highs through here, where again the market came up to these areas before rotating to the downside. So it's somewhat similar to what we saw through here, but just a little bit higher up here. So that area between 107.85 and 108.05 is going to be another target on the top side of further upside momentum. And if we are able to get outside of this trading range, this December up and down trading range that we've seen so far. Now on the downside, what do we have to look for? Well, we trade below the 105.15 level when we get more dollar buying here. Maybe interest rates start to move higher. Maybe we see stronger CPI data that forces that type of directional move to the downside here in the euro versus US dollar. Maybe the ECB is a little less hawkish than what we expect. So all those things can contribute to the move to the downside. And what is key for this currency pair on the downside is probably this area right through here. If we go below the 105.15 level and start to move further to the downside, we're going to start to look toward this swing area through here. You can see the number of different swing lows and highs that came in that area. Now, in the month of November, admittedly, the price moved above and below the area, but also near this area right here is a falling 200-day moving average. Currently comes in at 103.518. So it's a pretty decent way to the downside here. But again, we're talking about getting outside of this range through here. So if we get below that level, then the sellers are going to be pushing down toward this. We also think in terms of like, well, we failed above the 50% retracement. We had all these opportunities to move higher and we couldn't do it. Now we're getting some fundamental news that's forcing the dollar back to the upside. So going back to retest a 200-day moving average is certainly not out of the question for this currency pair. So watch this area down, or anticipate perhaps that we go down to that area if we start to get more dollar bullish type of get more dollar bullish data, or we get a more hawkish Fed. Now on the hourly chart, if on the daily chart the 200-day comes in at 103.51, I'm going to show you where that is. That's down here, right here. Now on the hourly chart, we have other levels in play here that would give us a clue as far as the downside goes for this currency pair. And in particular, I'm focused here on the 200-hour moving average. It's green line in the chart. And then we look at the 100-hour moving average. That's blue line in this chart. Get below both of those levels at 105.14, which is near the 105.15.5 level. Remember that. And then get below the 200-hour moving average at 104.85. And we open up the door for further downside momentum. The 38.2% retracement of the move up from this low right here to this high right here comes in at the 104.52 level, and getting below that level will be somewhat bearish. And then also getting below this low right here and trading this week what was key to the move back to the upside was the holding of the 200-hour moving average right through here. So that increases this 200-hour moving average's importance up here. We bounced off it here. Traders might expect to bounce off it again, even though it's higher. It's an easier hurdle to get to and through. Nevertheless, if we bounce off of it, that's going to keep the buyers more in control. So keep your eye out there, and then we'll be looking toward the 38.2, looking for this low, then looking toward the 50% retracement of the same move to the upside before we start to think in terms of getting to the 200-day moving average down here at the 103.51 level. So that's the progression on the downside here for the euro versus US dollar. On the top side, in addition to moving toward our high prices right here, we do have this swing area defined by a number of different swing lows and swing highs through here and right here. And we tried to move above it in trading here this week and could not sustain the momentum after we moved up toward our high found sellers. So watch this level 105.43 to 49 on the top side for the euro versus US dollar. Okay, let's take a look at the dollar versus yen and the dollar versus yen. We started the week off, or we start off below the 200-day moving average. Recall from last Friday, the price did close below that level, and then on Monday's trade, the market did open below that level and then start to move back to the upside. So we had that failure on the break of the 200-day moving average, and to show the significance of that, you have to go all the way back to here. This was the last time the price traded below the 200-day moving average, was back in February of 2021. So long time ago, we should have seen further downside momentum as a result of the break of that. We didn't see it when the market started to rebound back to the upside. Now, the move back to the upside did extend back above the 38.2% retracement of the 2022 trading range. This is the low right here. This is the high right here. 38.2% comes in at 137.24. And we can remember in the month of November, the market did find a lot of early buyers against that 38.2% retracement up to the 137.70 level. And although the price moved above that level in trading on Wednesday, it didn't stay there long. The market rotated back to the downside. So on the top side for the dollar versus yen, if we see more dollar buying, we're going to look toward the 137.24 to 137.70-ish type area. If we get above that level, then the market will be disappointed on the break of the 38.2, break of the 200-day moving average, and start to rebound back toward this swing area between the 139.31 and 140.30 level. Now, on the downside, if the price can stay below the 38.2, stay below the 70 level, we're going to be starting to look back toward the 200-day moving average at 135.04. And if the market gets below that level, it opens up the door for further selling potential, which could see the price move back down toward the 50% retracement of the same 2022 trading range. That level comes in at 132.70. So be aware of that on the downside for the dollar versus yen. Quick look at the hourly chart here, and you can see the move back to the upside on Friday's trade came up into the 100 and 200-hour moving average. So to start off the trading week, we're going to be using those levels as a barometer for bullish or bias. If the price moves above that level, it's more bullish. If the price moves below that level, it's more bearish. And the other thing in play here is this channel here. We have a nice top side channel through here, and we have a nice little bottom side channel level as well, where we have a number of different levels that came off of it. So be aware of breaking above the top side channel trend line or below the bottom side trend line. If we start to move further to the downside, start to move toward our 200-day moving average on the downside. That's this level right here in the dollar versus yen. Let's take a look at the sterling versus US dollar next. And on the daily chart here, we approached a swing area on the top side defined by these levels through here. Number of different levels where the market found either highs or lows through that level, and then we moved up toward it in trading over the last week or so of trading into that. That comes in between 122.78 and 122.27, 122.78, 123.31. I can see it. 122.78, 123.31. If we get above that level, that area, we're going to open up the door for the 61.8% retracement. Now, what is of significance off the daily chart as well is the ability to stay above the 200-day moving average. That's the green line in the chart that comes in at 121.19. If we move below that level, that would be more bearish for the sterling versus US dollar going forward into this trading week. So dollar buying gets below the 200-day moving average, would open the door for further downside with the 50% retracement of the 2022 trading range as being the next key target at 124.99. Taking a look at the hourly chart here. And off the hourly chart, we have a nice little channel as well coming in here where we have a number of different swing lows through here where the market bounced off of the level, including Friday off the PPI data, came all the way down, tested not only the trend line, but the 100-hour moving average, which is significant. We saw the rotation back to the upside. On the top side, we did get above this top side trend line here briefly, but then rotated back to the downside. So watch that top side trend line. Also the downside, the bottom channel trend line through here would be of significance in the new trading week. It's going to be just above the 100-hour moving average. Get below that level and get below the 200-hour moving average opens the door for further downside with the 200-day moving average, and also corresponding with the 50% retracement. So key off this hourly chart. This area through here is going to be somewhat significant down at the 121.21 level, both off the hourly and the daily and the daily chart. So be aware, be prepared for that level. Let's take a look at the dollar versus Swiss next, and I'm going to focus on the hourly chart in this currency pair. If we take a look at the hourly chart, what did we see in trading on Friday? We saw the price move to the lowest level of this cycle here. So the bears are continuing to keep in control. Also on the top side, what we saw this week was that the price tried to move above the 200-hour moving average through here. It lasted for about one bar before the market then rotated back to the downside and started to reuse that 200-hour moving average as resistance. That resistance continued on this day right here and continued on Thursday's trade as well. So sellers were leaning against the 200-hour moving average. And although we ping-ponged in between the 100 and 200 for most of this day here before rotating to the downside here, the market did break below the 100-hour moving average, increasing the bearish bias, and that's what led to the move to the downside here. Now, the 100-hour moving average and the trend line comes in at the same level, just above that is a 200-hour moving average. So in the new trading week, we're going to need to get above the 100-hour moving average, but above this trend line, get above the 200-hour moving average in order to increase the bullish bias here for the currency pair. That's the minimum. Then you can add the 38.2% retracement and then look at the 50% retracement, which also corresponds with this high right here. And you get my idea is that there's a lot of little levels here in the dollar Swiss that needs to get to and through on the top side, but with the roadmap is there. Okay, the roadmap to get above these levels through here are all there. It starts with the 100, then the 200, and then the 38.2, and then the 50%, and it gets us out of this box, and we start to look toward other upsides targets on the top side. On the downside, just stay below these levels, keeps the bears more in control versus on the dollar versus Swiss. So understand that, be aware of that. The bears are in control, the sellers are more in control in that currency pair. Dollar versus Canada, we moved up to the 61.8% retracement and tried to move above that on both Wednesday, Thursday, all three, Wednesday, Thursday, and Friday. Couldn't really sustain much momentum above the 136.89 level. The market rotated back to the downside, currently trading at 135.47. Probably it's kind of a sloppy chart, to be honest with you. What we can glean from, if I were to put a key level in on the top side in play, it would be ahead of the high price because we reached a new high right here, and then we had a lower high, and that was confirmed on Friday when the market moved up and found sellers against that level. So watch this 136.89 level on the top side. If we should head up toward there, if we get above that level, and then the 137 level, the high price was at 136.99, then that would be more bullish on the top side. On the downside, get below the 100, get below the 38, get below the 200-hour moving average, and the sellers are more in control for this currency pair. So be aware of those levels. Sloppy kind of chart for the dollar versus Canada. Let's take a look at the Aussie versus US dollar next. And if we take a look at this currency pair on the daily chart, what is significant to me from a technical perspective is this area through here. You see these swing lows right here, and then we broke below that level and used that level as resistance before rotating to the downside. In the month of November, admittedly, the market moved above and below that area. But in the month of December, what did we do in trading this week? We came down to that swing area, also near the 100-day moving average, and found support buyers. So the buyers leaned against that level, pushed the price over higher over the last 3 trading days, and that is what traders will be focused on in the new trading week. Stay above the 100-hour moving average. Stay above this swing area would be more bullish. On the top side, what do we have here on the daily chart? But we have another swing area in play. This is defined by these levels through here. Swing low, swing low, swing low, swing low. Rotate to the downside through here, and then back to the upside right here, where we had another bunch of swing lows through here, and the downside. And we had one break above here that failed, and then rotated to the downside. And we moved back to that area at the highs last week. So the market is paying attention to this level on the top side as well. So swing area on the top side, swing area on the downside, move above that, and we'll start to look toward the 200-day moving average, which also corresponds with the 50% retracement of the trading range for 2022. That level comes in at the 0.6915 level, key level on the top side in the new trading week. Get above that level either next week or going forward. It's more bullish here for the Aussie versus US dollar. On the downside, stay above the 100 is more bullish as well if we have a dip down toward that level. But if we move below that level, that's more bearish, as bearish, and would take the put the sellers more in control for the Aussie versus US dollar. Finally, from the currency perspective, let's take a look at the New Zealand versus US dollar. And what we know about this currency pair off the daily chart is the move above this swing area. This swing area defined at 0.6363 to 0.63948. A number of different swing levels through here, as outlined by these ubiquitous arrows that I always put in here. But lots of different swing highs and swing lows through here that the market used to define risk and define the bias before rotating to the downside. And in trading in the month of December, different from some of the other currency pairs, where in November we saw a rotation above and below these levels. We saw the price move above and below this swing area through here, but we are closing the week near the high, or above the high of this area, so that's more bullish. Now on the downside, what we've done in the month of December is stayed above the 200-day moving average. That's the green line in this chart. And if in the new trading week, if the market moves below that level, it's also moving below the 50% of the 2022 trading range as well. So that's a key level on the downside that we should pay attention to going forward, coming in at 0.62719. So move below that level would be more bearish. As long as we stay above that level on the daily chart, the bias remains more in favor of the buyers, with the this swing area being a barometer in between, and the 61.8 being another target on the top side for the New Zealand versus US dollar. If we take a look at the hourly chart for different other clues here, what I see here is a nice little topside channel trend line here, where we had a number of different highs, including on Friday's trade here and here and here. So there is some resistance up there, which comes in somewhere around, I don't know, 0.6420 something area right there. Move above that level, and then get above the high, and it's more bullish here for that currency pair. But you can see the resistance up there on the downside. This is the bottom side channel trend line, where we have a number of different support buyers. 100-hour moving average also moving up toward that trend line right here. So if we move lower, we'd be looking toward that area on the downside for the New Zealand versus US dollar. Now, I also want to take a look at some of the stock indices. We'll start off by taking a look at the S&P index. And what we know about the S&P is that this 100-day moving average was tested in trading last week. And for the most part, the market found support against it. It comes in at 3930.17. That's this point right here. And as long as the price is able to stay above that level, the buyers are still trying to hold on to control. What is disappointing in the S&P is that we did move above the 200-day moving average, but we could not sustain momentum above that level. That was the first time it moved above the 200-day moving average, going all the way back to this day right through here in the month of, what is that, May or so. So it could not sustain above that. The market's going to need to get above that level to increase the bullish bias. But the inability to get above that level has the sellers probably more in control. But we do need to get below the 100-day moving average to increase the bearish bias in the S&P. Now, take a look at the Nasdaq index, and whereas the market moved above the 200-day moving average, you can see the Nasdaq index is showing little less of upside momentum. In fact, the market found sellers against the 100-day moving average, at 1147922 currently. And as long as the price remains below that level, the bias remains more to the downside here in the Nasdaq index. So be aware of that level in the new trading week for the Nasdaq index. The 10-year yield also, we've seen a trend type move to the downside over the last month or so of trading, but the market did find support near the 50% of this last leg to the upside here. That took the yield up from about 2.51 to a high of 4.335. The 50% comes in at 3.426, and the low price reached just below that level before rotating back to the upside. We moved back above the 100-day moving average at 3.50. Nice little round number there. So pay attention to that level as a barometer for the upside or downside for yields. Yields drive the Forex market, or the Forex market drives the yields one way or the other. But we'll see how that all plays out. Also, it drives the stock market as well. Generally, higher yields will lead to lower stock prices. Higher yields lead to a higher dollar. Lower yields lead to a lower dollar and higher stock prices. So keep those correlations in mind as you trade this week. So there you have it. A look at a lot of the markets here today. Little views on the fundamentals that are going to drive the markets at the beginning during the week, including CPI and the central bank decisions. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.